The average man does not lose money because the market is against him. He loses because he is against himself. And nowhere is this more plain, more costly, than in the habit of holding a losing position. Now let me ask you something. When a trade moves against you, what is the first thing you feel? Is it analysis, or is it hope? You see, the moment a man refuses to take a small loss, he has ceased to be a trader and has become something else entirely. He becomes a defender of a bad decision, and the market has no mercy for men who defend mistakes. I learned early that losses are part of the business. They are not the danger. The danger lies in how a man behaves after the loss begins. When a stock moves against your position, it is giving you information. It is telling you, plain as day, that your judgment, at least for the moment, is wrong. Now, what does the average trader do with that information? He ignores it. He explains it away. He tells himself the market is temporarily irrational. But tell me, have you ever known the market to care about your opinion? A loss begins small. It is manageable. At that stage, it is nothing but a business expense. But when a trader refuses to act, that small loss grows. And as it grows, something else grows with it. Emotional attachment. That is where the real trouble begins. Because once a man becomes emotionally involved in a losing trade, he is no longer thinking in terms of capital. He is thinking in terms of being right, and the market does not reward being right. It rewards being disciplined. Let us consider the cause and effect of this behavior. When a trader holds a loser, he ties up his capital. When his capital is tied up, he cannot act on better opportunities. When he misses better opportunities, frustration builds. And when frustration builds, he begins to make impulsive decisions. Do you see the chain? One bad habit leads to another, and before long, the trader is no longer operating with a plan. He is reacting, hoping, defending. Now here is something worth remembering. A losing trade is not your enemy. Your refusal to exit it is. I have always said that the big money is not in the thinking. It is in the waiting. But that waiting must be done in the right position. Not in a losing one. Never in a losing one. Let me ask you again. Why do you hold a losing trade? Is it because the chart tells you to? Or because you cannot bear to admit you were wrong? If you study your charts honestly, without bias, you will notice something. When a trade is right, it tends to move in your favor without much hesitation. It may pause, yes, but it does not fight you every step of the way. But when a trade is wrong, it drifts, it struggles, it fails to follow through. And yet, the average trader will hold on to that kind of action as if it were about to turn into profit at any moment. Why? Because hope is cheaper than discipline. Now, I am not telling you to exit a trade at the first tick against you. That would be foolish. The market has noise. It breathes. But there is a difference, clear as day, between normal fluctuation and a trade that is not working. Your job is to learn that difference. When a stock breaks the level that justified your entry, when it violates the structure you relied upon, you must act, not later, not after confirmation, at once. Because when you delay, the loss grows. And when the loss grows, your judgment weakens. Have you noticed that? A small loss is easy to take. A large one is not. And so the longer you wait, the harder it becomes to do the very thing you should have done at the beginning. That is the trap. Now consider the professional operator. He does not argue with the market. He does not negotiate with it. He does not hold a losing position and hope for redemption. He exits, quickly, quietly, without emotion, and once he exits, he is free, free to observe, free to reassess, free to act again when the opportunity is right. That freedom, that clarity, is worth more than any single trade. You must understand this if you are to last in this business. Capital is not just money. It is opportunity. And every dollar tied up in a losing trade is a dollar that cannot be used when the market presents something better. So the question becomes, are you managing your capital, or are you imprisoning it? Because the market will always offer another chance, but it does not wait for those who are stuck. Now let us bring this back to something practical. Before you enter any trade, you must know where you are wrong, not where you hope to be right. Where you are wrong, that point must be clear, defined, non-negotiable. And when price reaches that point, you exit. No debate, no second guessing. If you cannot do that, if you hesitate, then the problem is not your strategy, it is your psychology. And psychology, in trading, is not something you fix with more indicators. It is something you discipline through action. You train yourself. You take small losses consistently, until the act itself becomes natural, until it no longer feels like failure, but simply part of the process. Because that is what it is. A trader who cannot take a small loss will eventually take a large one. That is not theory. That is experience. And the market has a way of teaching that lesson over and over again, until it is learned. Now think carefully, how many times have you watched a small loss turn into something much larger, simply because you waited? And how many times did the market give you a chance to exit early, but you chose not to? That is not bad luck. That is behavior. And behavior can be changed, but only if you are willing to see it clearly. The charts will show you the truth if you let them. Price does not lie. It reflects reality in its purest form, but you must be willing to accept what it shows you, even when it contradicts your position. Hope enters where discipline exits. That is not a clever phrase. It is a plain observation of how men lose money in the market. Let me ask you something. When a trade begins to move against you, do you reach for your rules, or do you reach for reasons? Because the moment you start explaining why a losing position might still work, you have already stepped away from discipline. You are no longer following a plan. You are negotiating with reality, and the market does not negotiate. In the beginning, every trade is simple. You see a setup, you define your risk, and you act. There is no confusion at that stage, but once price moves against you, something changes. The mind begins to interfere. It suggests patience where there should be action. It offers hope where there should be judgment, and hope, in trading, is expensive. You see, discipline is not just about having rules. It is about obeying them at the exact moment they are hardest to follow. Anyone can plan an exit when the market is closed. The real test comes when price is moving against you and your position is losing money. Now tell me, what usually happens in that moment? The trader hesitates. He tells himself the move is temporary. He looks for confirmation that supports his original idea. He begins to ignore what the chart is showing him now and instead focuses on what he believed before. That is hope taking control. And when hope takes control, discipline disappears quietly. Not all at once, but just enough to delay action. And that delay is all it takes. Because when a trader delays exiting a losing position, the loss grows. And as it grows, so does the emotional weight attached to it. A small loss can be handled calmly. A larger one begins to affect judgment. Have you noticed how your thinking changes as the loss increases? At first you are willing to exit. Then you want to give it a little room. Then you decide to wait for it to come back. And before long, you are no longer managing a trade. You are enduring it. That is the cost of replacing discipline with hope. Now let us consider the chart itself. Price does not need your belief to move. It does not care about your entry. If a stock fails to hold its level, if it breaks structure, loses momentum, or cannot follow through, then it is telling you something very clear. The trade is not working. At that point, discipline demands action. Not analysis. Not justification. Action, but hope will whisper otherwise. It will tell you that the move is not finished, that the market is shaking out weak hands, that your original idea is still valid if you just wait a little longer. And that is how losses grow. You must understand this clearly. Hope is not neutral. It is not harmless. It has a direction. It always leads to inaction when action is required. When a trader follows discipline, he acts quickly and preserves capital. When he follows hope, he delays and increases risk. That is cause and effect. Simple and repeatable. Now consider what this does to your account over time. One disciplined exit keeps your losses small and controlled. But one hopeful decision can erase several good trades, not because the market was unpredictable, but because you failed to respond to what it showed you. So the real question is not whether you have rules. Most traders do. The question is, who is in control when those rules are tested? Because in that moment, there are only two forces at work. Discipline, which is based on preparation and logic, and hope, which is based on emotion and avoidance. Price action is information, not opinion. That is something a trader must come to understand early, or he will spend years arguing with the market instead of learning from it. Let me ask you, when you look at a chart, are you reading what is happening, or are you searching for confirmation of what you already believe? Because there is a difference, and that difference costs money. The market speaks in price. Every movement, every breakout, every failure, every pause is a message. It is not there to agree with you. It is there to tell you what is actually taking place between buyers and sellers. Now the trouble begins when a trader starts treating that message as an opinion rather than a fact. A stock breaks below support. That is information. But the trader says, it will come back. A trend weakens. That is information. But the trader says, it's just a pullback. Volume dries up. Momentum fades. Still, the trader holds his ground. Not because the chart supports him, but because his opinion does. And tell me, what weight does your opinion carry in the market? None. That is the hard truth. The market does not reward interpretation that ignores reality. It rewards alignment with what is actually happening. When price moves in your favor, it confirms your position. When it moves against you, it contradicts it. That contradiction is not something to be debated. It is something to be acted upon. But most men do the opposite. They treat price as flexible, as if it can be bent to fit their expectations. Now consider what follows from that behavior. When you ignore price, you delay decisions. When you delay decisions, losses grow. When losses grow, your thinking becomes clouded. And when your thinking is clouded, you begin to make even poorer judgments. Do you see how it builds? All because you chose to treat information as opinion. Now let us bring this into something practical. Before you enter a trade, you form a thesis. That is necessary. But once you are in the trade, the chart becomes your guide, not your thesis. If price confirms your idea, you stay. If it contradicts your idea, you adjust or exit. Simple in principle, difficult in practice. Why difficult? Because the mind resists being wrong. It prefers consistency over accuracy. It would rather defend an idea than abandon it. And that is where discipline must step in. You must train yourself to see price as neutral. Not good, not bad, just true. If a level breaks, it breaks. If a trend fails, it fails. Your job is not to argue. It is to respond. Have you ever held a position while watching the chart clearly move against you and still done nothing? In that moment, you were not trading the market. You were trading your belief, and belief has no place in execution. Execution must be based on evidence, on what price is doing now, not what you think it should do. That is why the best operators are not stubborn men. They are flexible. They shift with the market because they listen to it. They do not impose their will upon it. Now here is something worth remembering. The chart will always tell you more than your thoughts will. If you are willing to read it honestly, when a breakout fails, it is not a mystery. When a trend cannot continue, it is not random. These are signals. Clear, observable, repeatable. But only if you treat them as facts. The moment you begin to reinterpret those facts to suit your position, you lose your edge. You stop reacting and start rationalizing. And rationalizing is what keeps traders in losing positions. So the next time price moves, ask yourself, am I observing or am I insisting? Small losses preserve both capital and clarity. That is not just a rule. It is a principle that separates the steady operator from the struggling one. Now let me ask you, when you take a small loss, do you feel relieved or do you feel defeated? Because how you answer that question will tell you everything about how you trade. You see, the average man treats a loss as a personal failure. He takes it to heart. He remembers it. And because he wants to avoid that feeling, he begins to delay taking the next one. That is where the trouble begins, because a small loss, taken quickly, does very little damage. It leaves your capital mostly intact, and more importantly, it leaves your thinking clear. You can step back, observe the market, and act again without hesitation. But when a trader avoids that small loss, something else happens. The loss grows, and as it grows, it begins to affect not just his account, but his judgment. Have you noticed how different the market looks when you are stuck in a losing trade? Every tick feels heavier. Every movement feels personal. You stop seeing opportunities. You only see your position. You are no longer reading the market. You are reacting to your own discomfort. That is the loss of clarity. Now consider the cause and effect. When you take a small loss, you accept reality quickly. When you accept reality, your mind stays flexible. When your mind stays flexible, you are able to respond to new opportunities. But when you refuse that small loss, you resist reality. When you resist reality, your thinking narrows. And when your thinking narrows, you begin to make poor decisions. Do you see how it connects? Capital and clarity move together. Protect one, and you protect the other. Lose one, and the other follows. Now let us bring this down to the chart. When you enter a trade, you are acting on a specific idea. A level, a breakout, a trend, something that gives you an edge. But if price fails to behave as expected, if it cannot hold that level, if momentum disappears, then the premise of your trade is no longer valid. At that moment, the correct action is simple. Exit. Not because you are certain the trade will fail, but because the reason for being in it has weakened. And when you exit early, you keep your loss small. That small loss is manageable. It does not disturb your confidence. It does not cloud your thinking. It allows you to remain objective. Now ask yourself, how many good decisions have you missed because your mind was occupied with a losing trade? That is the hidden cost. Not just the money lost, but the opportunities missed while your attention was trapped. The professional understands this. He does not aim to avoid losses. He aims to control them. He knows that by keeping losses small, he stays in the game. He preserves both his capital and his ability to think clearly. And that clarity allows him to recognize when the market is offering something worth acting on. Because the market always offers something, but only to those who are ready. Now here is something worth considering. A trader who takes small losses consistently builds confidence, not because he is always right, but because he knows he can protect himself when he is wrong. And that confidence is quiet. It does not come from winning. It comes from control. But a trader who allows losses to grow loses that control. He begins to doubt his decisions. He hesitates. He second guesses. And soon, even good setups become difficult to act on. All because he failed to take a small loss when it mattered. So the question becomes, are you protecting your capital, or are you testing your tolerance for pain? The market punishes hesitation more than error. That may sound strange at first, but any man who has spent time trading will come to see it plainly. Now let me ask you, have you ever made a wrong decision quickly, taken the loss, and moved on, only to recover later with a better trade? And have you also done the opposite? Hesitated on a clear decision, delayed action, and watched a small mistake grow into something far worse? There lies the difference. An error by itself is not dangerous. Every trader makes them. The market does not expect perfection. But hesitation, that is where damage multiplies. Because when a trader hesitates, he gives the market time to move further against him. And the market, being what it is, rarely waits for a man to make up his mind. In the beginning, the signal is clear. A level breaks, a setup fails. The condition that justified your entry no longer exists. That is the moment for action. But what does the average trader do? He pauses. He wants to be sure. He wants confirmation. He tells himself he will act if it gets worse. But not yet. And in that small window of hesitation, the situation changes. Price moves further away. The loss increases. And what was once a simple decision becomes a difficult one. Have you noticed how a 5-minute delay can turn a clean exit into a painful dilemma? That is the cost of hesitation. Now consider the cause and effect. When you act quickly on an error, the loss remains small. When the loss is small, your mind stays calm. When your mind is calm, you are able to make your next decision with clarity. But when you hesitate, the loss grows. When the loss grows, pressure builds. And when pressure builds, your thinking becomes distorted. You begin to hope. You begin to negotiate. You begin to avoid the very action that would have protected you in the first place. That is how hesitation turns a mistake into a problem. Now let us bring this to the chart. When price violates your level, clearly, decisively, that is not a suggestion. It is information. It tells you that the trade is no longer behaving as expected. At that moment, speed matters. Not reckless speed, but prepared speed. The kind that comes from knowing in advance Where you are wrong. If you have defined that point before entering the trade, then there is no need to think when price reaches it. You act. But if you have not defined it, then you are forced to decide in real time. And real-time decisions, under pressure, are rarely clean. Let me ask you, do you decide your exits before the trade or during it? Because that single difference determines whether you act with discipline or hesitation. The professional does not wait for the market to force his hand. He anticipates the moment of decision. He knows exactly what he will do if price moves against him. And when it happens, he does not hesitate. That is not because he is fearless. It is because he is prepared. Now here is something worth remembering. The market often gives you a narrow window to act correctly. Not wide, not generous, just enough. And if you miss that window, the cost increases. A delayed exit becomes a worse exit. A worse exit becomes a burden. And that burden affects every decision that follows. So while a wrong trade can be corrected quickly, hesitation compounds the damage. It is not the mistake that hurts you. It is the time you spend refusing to correct it. Capital trapped in losers cannot seize opportunity. That is a fact a trader learns not from books, but from watching good trades pass him by while he is stuck in bad ones. Now let me ask you, how many times have you seen a clean setup form, one that fits your rules perfectly, and yet you could not take it, not because you didn't recognize it, but because your money was already tied up? That is the quiet cost of holding losers. You see, most traders think only in terms of profit and loss. They look at a losing position and say, it's not realized yet. But the market does not care whether a loss is realized or not. If your capital is committed to a trade that is not working, it is unavailable. Unavailable capital is missed opportunity. Now consider the cause and effect. When you hold a losing position, your funds are locked. When your funds are locked, your flexibility disappears. When flexibility disappears, you cannot respond when the market offers something better. And the market always offers something better, but not always at the same time. So while you are waiting for a bad trade to recover, a good trade forms elsewhere. It breaks out cleanly. It moves with strength. It does exactly what you were hoping your current position would do. And you watch it. Tell me, what does that do to your thinking? Frustration begins to build. You start comparing. You begin to resent the position you are in. And instead of managing your current trade objectively, you are now reacting emotionally to what you are missing. That is how one mistake spreads into many. Now let us bring this back to the chart. A proper trade shows progress. It moves with intent. It confirms your decision early, even if not perfectly. But a poor trade lingers. It drifts. It fails to follow through. And yet traders will hold that kind of position, not because it deserves capital, but because they have already committed to it. That is not trading. That is attachment. Have you ever stayed in a weak trade simply because you were already in it? That is not a decision based on opportunity. That is a decision based on past action, and past action has no value in the present market. The only question that matters is this: if you were not in the trade right now, would you enter it? If the answer is no, then why are you holding it? Now consider the professional approach. He does not think in terms of individual trades. He thinks in terms of capital allocation. Where is my money best used right now? If a position is not performing, it does not deserve capital. It is that simple, and when he exits, he does not feel loss alone. He feels regained flexibility. He is no longer tied down. He is free to observe, to wait, and to act when something better appears. That freedom is an asset, because the market rewards those who are ready, not those who are occupied. Now here is something worth remembering. The best trades often come when you are clear, focused, and unburdened. But if your attention and capital are trapped in a losing position, you are neither clear nor free. You are stuck, and a stuck trader cannot operate effectively. He hesitates, he overthinks, he misses timing, and even when he does act, he does so with less confidence. All because his capital was tied to something that was not working. So the discipline of cutting losses is not just about avoiding damage. It is about maintaining readiness. Because in this business, opportunity does not announce itself in advance. It appears and it moves. Being right matters less than reacting correctly. That is a lesson most traders resist, because it goes against something very human, the desire to be proven right. Now let me ask you, when you enter a trade, are you trying to make money, or are you trying to prove your judgment? Because those are not the same thing. A man can be right about the market's direction and still lose money if he reacts poorly, and another man can be wrong at the start, correct himself quickly, and still come out ahead. That is the difference between prediction and execution. The average trader places too much weight on being right. He studies, analyzes, builds a case, and once he enters a position, he becomes committed to that case. Not financially at first, but mentally. And once he is mentally committed, he begins to defend the position instead of managing it. Have you ever noticed how difficult it becomes to exit a trade once you have convinced yourself it should work? That is the trap, because the market does not reward conviction, it rewards correct action, and correct action often requires abandoning your original idea. Now consider the cause and effect. When a trader focuses on being right, he resists contradictory information. When he resists that information, he delays action. When he delays action, losses grow. And when losses grow, his need to be right becomes even stronger. Do you see the loop? The more wrong he becomes, the more he wants to prove he was right all along. And that is how losses turn into disasters. Now let us bring this to the chart. You enter a breakout. It looks clean. Volume supports it. The structure is sound. But then something changes. The price stalls. It fails to follow through. It dips back into the range. That is information. At that moment, the question is not, was I right to enter? The question is, what is the correct action now? If the trade is no longer behaving as expected, then your response must change. Not your opinion, your action. But the trader who is focused on being right will hold. He will say, the setup is still valid. He will wait for the market to confirm what he already believes. And in doing so, he ignores what the market is telling him in real time. Now ask yourself, how many losses have come not from a bad entry, but from a failure to react after the entry? Because that is where most of the damage occurs. Entries can be imperfect. That is part of the game. But exits, those must be precise. They must be based on what is happening, not what you expected to happen. The professional understands this. He does not marry his ideas. He tests them, and if the market disagrees, he steps aside, quickly, without argument, because his goal is not to be right. It is to stay aligned with the market. Now here is something worth remembering. The market is always right in one sense. It reflects the current reality. Your opinion may be logical, well-researched, even correct in the long term. But if price is moving against you now, then in that moment, you are wrong in execution. And execution is where money is made or lost. So the trader must learn to separate ego from action. To say, I may have been wrong, and act accordingly, without hesitation, without discomfort. That is not weakness. That is control. A trade that struggles early often fails later. That is not a rule, without exception, but it is an observation that repeats itself often enough to be respected. Now let me ask you, when you enter a trade and it begins to hesitate almost immediately, what do you tell yourself? Do you see it for what it is, or do you begin to explain it away? Because the early behavior of a trade tells you more than most traders care to admit. When a position is right, it tends to show it early. It does not need much encouragement. It moves with purpose. It may not explode at once, but it acts with intent. There is follow-through. There is strength behind the move. But when a trade is wrong, or at least poorly timed, it reveals that too. It stalls. It moves in small, uncertain steps. It fails to build momentum. It cannot separate itself from your entry. And yet, many traders will sit with that kind of action waiting for it to improve. Why? Because they are focused on what they expected, not on what is happening. Now consider the cause and effect. When a trade struggles early, it signals a lack of demand or conviction in that move. When there is no conviction, price tends to drift or reverse. And when price drifts, time works against you. The longer a trade takes to prove itself, the less reliable it becomes. Have you noticed how the best moves rarely give you much doubt at the beginning? They may test you briefly, but they do not linger. they move. That is because strong opportunities attract immediate participation. Buyers step in, sellers step out. The imbalance becomes visible quickly. But when that imbalance is missing, the trade lacks energy. It becomes dependent on hope rather than momentum. Now let us bring this to the chart. You enter a breakout above resistance. It looks clean. But instead of pushing higher, price hovers around your entry. It moves up a little, then back down. Volume does not expand. The move lacks urgency. That is information.